All right, here we go. Great. So thanks everyone for joining. This is the next in the series of Tide 10, Tide being the Investment Diversity Exchange. Tide is a woman-owned minority firm globally promoting ethnic and gender diversity within the investment industry. My name is Prentice. I'm a strategic account director at Qontigo. Qontigo is a financial intelligence innovator and leader in the modernization of investment management from risk to return. The combination of our group's world-class indices and best-of-breed analytics with our technological expertise and customer-driven innovation enables clients to achieve competitive advantages in a rapidly changing marketplace. Our global client base includes the world's largest financial products issuers, capital owners, and asset managers. But enough about me. I'd like to introduce the star of the show today. It's my pleasure to introduce Mr. David Francl, who is a managing director of the Absolute Return portfolio for the San Francisco City and County Employees Retirement System. Now, I can tell you a lot of great things about David. Professionally, he spent 18 years at Intel Corp at a variety of management roles, most recently as a director of the Treasury Retirement Investments, responsible for building the $3 billion hedge fund portfolio, asset allocation, attribution, cash management, reporting, and risk for the overall $15 billion pool of funds of retirement assets, or that he holds a BBA from the University of Wisconsin, an MBA from the Haas School of Business at Cal. But he's also a husband and a father of two, and one of the most avid wine connoisseurs that I've ever met in my life. It's been my pleasure to know David for over 10 years now, both professionally and personally. So thank you, David, for joining us today. Look forward to the conversation.
Thank you, Prentice. Thanks for that wonderful introduction, and happy to be with you. As you can see, I'm joining you guys today from beautiful Incline Village, and look forward to our conversation.
Great. So obviously the current marketplace right now, key in the minds of investors. And so perhaps just to start off, how do hedge fund portfolios like yours manage to, look to mitigate risk in this uncertain environment?
The hedge fund thesis is definitely intact. And I think a lot of investors have seen that really proven out through the most recent dislocation that we experienced in March of this year. On our side, we would have liked to have seen a little bit better downside risk mitigation from our portfolio, but as with a lot of diversified hedge fund portfolios, we have exposure to many different sub-strategies, and probably similar to a lot of other institutions, we saw massive amounts of dispersion. There were some strategies that I think showed that they had a lot of hidden beta and a lot of hidden sensitivity to economic growth in them. Unfortunately, we had a little more of that exposure than I would have liked. But on the other hand, we had exposure to a lot of strategies that performed very well, and actually, really demonstrated that element of downside risk mitigation, returns being sourced from somewhere other than equities or fixed income, and really exhibited, that uncorrelated kind of holy grail that a lot of investors seek when building a hedge fund portfolio. And here I'm really referring to like some of the there's some quant strategies, some strategies that operated with lower net. There were some long-short equity strategies that we had that were invested in technology names, and some names that were particularly rewarded as a result of COVID-19 and the economic lockdown, and people doing a lot more from their homes. And these are things like social media companies and things like that. That the stock of those companies ran significantly as a result of the COVID-19 situation. So those types of strategies perform very well. On the balance, that as this all came together, and I think we saw it in some of the hedge fund indices and the marks that they produced, still losing money during the month of March, but losing significantly less than what we saw out of a lot of the global equity markets. And I think we've seen here since, in the months since, equity markets have bounced back significantly. But you take a deeper look at those equity markets, and you will see that that performance is really driven by a handful of stocks, and that a lot of stocks in equity market indices are still negative for the year. Some of them significantly negative. I saw something recently that broke the performance of the S&P 500 by market cap down into 5 quintiles, and the second through fifth quintile are still negative year to date. It's really just that top quintile, and even more specifically, a handful of technology names that are really driving that equity market performance. Hedge funds, on the other hand, through the second quarter, actually performed quite well. In my portfolio, it was probably the best quarter's worth of performance in the history of my managing hedge fund portfolios, now close to 2 decades. Would love to be able to annualize that type of performance, but that may not be realistic. Nonetheless, we've seen quite a bit of recovery from some of the assets that were hit really hard during the month of March. And we've also seen that a number of other strategies, quant, fixed income relative value, strategies that benefit from things like index rebalancing, where those activities didn't happen in the normal course of business during Q1, and all of that activity was pushed into Q2. Those generated some particularly rewarding trades for managers that trade in those strategies. On the whole, again, I think the thesis is still intact here, and a lot of investors, really got what they were seeking out of hedge fund portfolios during Q1. As a result, we're reading about a lot of institutions in the media that have been increasing their allocations to hedge funds and those types of strategies, based on the idea that this is not over, and that we're likely to see elevated levels of volatility, and we could, with all the uncertainty that exists in the world, we could see some more meaningful dislocations.
No, I think that's super helpful. I think one of the things that you touched on, and certainly towards the end there, that kind of leads into my second question. Over the past handful of years, we've certainly seen asset allocations fluctuate, and certainly certain asset classes like private credit, private equity picking up in popularity as more investors are looking to for that absolute dollar. But at the same time, some of it has been at the expense of some of their hedge fund allocations. How does SF look at the overall asset class in itself, and using that term loosely, what more vehicle for investment than anything else, but how does the plan look at the overall, maybe in a strategic asset allocation perspective? Has the conviction changed in one direction or another? Too early to tell. What are some of the behaviors that you think are going to kind of tie into it long term?
Well, your question is very timely, because we are actually in the middle of doing some research and a small restructuring of our absolute return portfolio. We do look at absolute return and treat it as an asset class component of our strategic asset allocation. And to my point in the prior question, where we would have liked to have seen better downside risk mitigation out of our absolute return portfolio during Q1 of this year, that's driving some of the analysis that we're conducting right now. And the current thinking is that we would like to have our absolute return program evolve into and have the next phase be something where there is more of a focus on downside risk mitigation and liquidity. And that second point being a very critical one, because during the month of March and the early part of April, we came under significant liquidity pressure. We have a very large, somewhat unusually large allocation to alternative investments in the aggregate in our plan. They comprise a total of 60% of the plan portfolio. And 15% of that is absolute return, but the other 45% is in capital call drawdown type vehicles. And so when the markets dislocated in Q1, many of those managers did exactly what we underwrote them for. Mm-hmm. We underwrote them to do, and to call capital during a period of dislocation when there are great opportunities to purchase assets at depressed prices. And so, the downside of that is it put a lot of liquidity pressure on us, and we had to sell some assets that we would have preferred not to. And so as we think about the next evolution of absolute return and how do we get the most meaningful ROI out of this allocation of capital, one of the things that we're putting a higher priority on is liquidity. And so as we think about what the next phase might look like, it's very likely going to include a larger component of highly liquid strategies that are also really intended to perform during environments like we saw in Q1 of this year. To be a little bit more specific on there, probably incorporating more things like GTAA, CTAs, and things that are managed with a large utilization of derivatives and things that can be sold pretty much immediately, and also give us the opportunity to be very bespoke in how we create this, and to take into account what our aggregate plan exposures are at any point in time, such that the amount that we allocate to these more diversifying and downside mitigating strategies really function as a ballast for the rest of the portfolio.
Great. So as you're developing this portfolio, kind of the next step is sourcing managers or thinking about strategies that fit into the mix. Given the dynamics, just from a logistical standpoint of, meeting with managers and speaking with managers, kicking the tires and so forth, how do you stay in touch with the existing managers that you have, in addition to, how would you kind of think about sourcing managers and sourcing new ideas when we're all kind of living in a very different world than we used to, call it, 4 months ago?
Yeah, it's a very interesting question, Prentice. And I've actually been really surprised at how the situation has played out amidst COVID. I used to spend probably at least a third of my time on airplanes and traveling in order to meet existing managers, meet with prospective managers, meet with my peers, other LPs. And obviously, all of that came to an abrupt end in early March. But, when you might initially expect that the ability to communicate is somewhat impaired because people can't get together physically anymore, I've actually seen some real positives come out of this, and the frequency of the interaction that we have with our partners, our existing investment partners, has actually increased. We, in the past, where we might have had maybe 1 or 2 touch points per month with them, now we have at least at a minimum one call or virtual meeting once every 2 weeks. So we're getting a better, more frequent interaction with them. And we're also getting really good transparency. I've been very pleased with some of the details that managers have shared about attribution, what drove losses, to the extent that they occurred earlier this year, how are they positioning, how are they incorporating their research into, the way their portfolios are constructed. That has all been really good. We haven't done as much of underwriting new relationships in the last couple months. And that kind of ties back to, what I shared in the question earlier, as we go through a little bit of a restructuring. But I don't really see that being impaired. I think there's very strong idea flow. I've reviewed more co-investment recommendations in the last month than I had in the 4 months prior. And so, there's a lot of deal flow that is coming, a lot of idea flow. And, COVID has absolutely not slowed that down. It's forced us to work differently, but I think to take advantage of all of the tools that are available to us and take advantage of what top technology enables. We've seen a lot of fundraising occur, and there's been a lot of capital that has been raised for funds like dislocation funds and things of that nature. We've seen a lot of managers who have been closed for extended periods of time taken new capital for the first time in many years. So the investment markets are moving as if nothing ever stopped. And I don't think we've had to modify our methods of doing diligence and communicating, but I don't really think we've missed too much of a beat on that.
I can certainly echo the sentiment for someone who's like myself, that's on the road typically 40% of the time. It's been a stark change in approaches, but the adapting to kind of this new reality, and likely for some time going forward, has opened a lot of opportunities from that standpoint to find different ways to engage with clients and prospects as well. So along those lines, when you're looking at selecting new managers, when you think about the portfolio and the level of diversity within it, is there a component within adding managers or, constructing existing manager, even throughout this, the San Francisco organization, about how you build things through some level of diversity or some degree of difference of thoughts and backgrounds and context, to the point where you have minority owned or women owned enterprises within the hedge fund portfolio, within the overall organization? within the plan. Maybe walk us through a little bit of how the organization thinks about things along those lines.
Yeah, and Prentice, as you might expect, we're very focused on this. And in San Francisco, being a city that really embraces diversity and has for many generations, you would naturally expect that the organization that runs its pension plan to really think of things in that mindset. And we absolutely do. We have incorporated ESG across our investment process. It doesn't drive our investment process, but it is a lens that we look at every investment opportunity through. And we have a director on our investment team who is really our point person for that, but he's a partner of every other individual on the investment team and works with us to help us try to identify issues that exist with strategies and with managers, and participates on our due diligence calls. And it's really interesting because we found that we often learn something different and unique about the firm that we're considering working with through those calls that were it not for a line of ESG questioning, we probably wouldn't have learned those things. So it's a very valuable part of our process. Our investment team as well definitely exhibits a high degree of diversity. 2 of our 4 managing directors are women. We also have multiple cultures represented among our entire investment staff. It's a very diverse group. And if any of you have an opportunity to pull down interviews that have been conducted with our CIO, Bill Coker, on the topic, you will see the same. And that's one of the things that I think Bill is very proud of in the team that he has constructed, very talented investment professionals, but also a highly diverse organization that brings together a lot of backgrounds and viewpoints. And we're believers that makes for a better process and better results in terms of the relationships that we have, the managers that we hire. We also measure up very well our metrics there in terms of investing in emerging managers, in minority-owned firms, in women-run businesses. Our metrics there, we're actually just in the process of updating those, but the data that I've seen thus far shows that we measure up very favorably there, and that we also really like the idea of investing in smaller firms. Small firms typically, big firms usually started as small firms, and it's their success that got them there. And we're believers that in constructing a large diversified portfolio across asset classes, sometimes some of your best ideas come from those smaller niche players, and our portfolio definitely reflects that.
No, that's certainly an example, I think, for other public plans to follow, and certainly something that, as Bay Area residents, I think we see it as almost being normal, but certainly can take cues for the rest of the investment community, can take cues from the stance that we've observed. But so final parting question, and something a little bit off topic, but lesser known fact, not a little known fact, that you had your own wine label and produce your own Bordeaux blend of wine, which I've had the privilege of tasting. It was excellent. What is the next chapter for David Francl in the winemaking industry at this point?
Well, that's kind of on hiatus right now. I haven't produced a vintage in a few years, and I guess I would just say the next chapter is just continuing to enjoy the few remaining cases of inventory that I have of every vintage that I did produce.
Sounds good. I definitely finished both bottles in pretty fast form, so I might have to knock on your door in Incline Village there and see what you got left in the inventory.
Sounds good.
Well, David, I appreciate your time today. Thanks again for your comments regarding your plan, and have a good one.
Absolutely. Thank you, Prentice. Appreciate the opportunity, and to all folks out there, mask up, continue to social distance, stay healthy and well, and hope to see many of you in person at some point in the not too distant future. Thanks, everyone.
Sage words. Thank you so much, and that'll do it for this Tide 10.